Hi, I'm Tom Lydon, editor of ETF Trends here in Hollywood, Florida at the Inside ETF conference. And I'm here with Arne Noack and Rob Bush from Deutsche Asset Management. Gentlemen, great seeing you.
Good to see you, Tom.
Good to see you.
So let's look at 2017. A lot's happened already, but with the new Trump administration and his kind of pro-growth environment, less regulation, the average small and mid-sized company in the US that has a lot to do with our GDP is feeling pretty good, and the market's been showing that. Do you think that this might continue?
Certainly what we can see in some of our strategies since Trump was elected is the small and mid-sized companies have really taken off. DEUS as well as DESC to large and mid-blend as well as a small cap strategy have really outperformed over last year after the election. And even this year we don't really see that trend ending so far.
So that's a couple of smart beta strategies that you folks have, correct?
Correct, yes.
And again, as advisors maybe are more correlated towards large cap, here's a way to kind of get a smarter allocation to small and mid. Is that right?
That's correct. So, for example, DEUS works within the realms of the Russell 1000, but tilts towards the smaller cap names. And in addition to this, utilizes, for example, the low vol factor in order to minimize downside risk.
Gotcha. Okay, so Rob, once this happens and we continue to see inflation pick up, because if wage growth continues to advance as well, Fed's going to have no choice but to continue hiking rates. What's that do to the dollar, and especially what does that do to foreign markets and their currencies?
Yeah, I mean, it's a great question, Tom. I mean, you look at the reaction post-election in the dollar and in markets generally. Certainly the dollar's a big fan of Trump's election. We had a huge run-up post-election. Dropped off a little bit since then, sure, but I think that broadly speaking, we're still positive on the dollar for 2017. And I think that when if you want to analyze dollar's strength and what that means for international currencies, you sort of have to look at the big international currencies. So you need to at least consider euro, you have to look at the yen, you have to look at the pound. Those are the big three. You throw in the Swiss franc, you've got the big four. But as an investor, those are the ones that are really going to be critical. So if you've got dollar strength, we're going to be forecasting weakness. Euro dollar, we've got going to parity. Dollar yen to 120. We think the pound has got a little bit more weakness still to come, maybe going down to 118. Those are all forecasts for further depreciation from here.
Yeah. So advisors do have global allocations, but for the most part, they're all based within those local currencies. And if, for example, Europe were to even be flat for the next 6 months, but the dollar would appreciate by 10%, then those foreign investments would actually decline by 10% because of the weakness in that local currency, correct?
Yeah, correct. That's the right way to think about it. So think about if you're investing internationally, you're long two assets, right? You're long the asset that you're actually purchasing, and you're long the currency that it's denominated in. So that's the right way to think about it. If you don't hedge, you've got that long in your portfolio. So you need to have thought pretty carefully about what that means, what your forecast is for that currency.
Yeah. So your currency hedge suite, it can get real specific to regions of the world and so people have a lot of choices, even emerging markets. But maybe the average advisor that has an actively managed mutual fund that's not currency hedged, there's a way to buy one of your kind of all-world opportunities that currency hedge globally to offset that currency risk without actually selling or deallocating from a certain asset class, correct?
Yeah, that's correct. Yeah, it's certainly an option. And like you say, so you've got single currency exposures, you've got regions, you've got all world. But the critical difference, as you've alluded to, Tom, is that if you go down that road, you'll have the same equities, but you won't have the long position in the currency. You'll effectively have removed that. And if you think about the kind of additional volatility that currency can bring to a portfolio, that could be attractive, yeah.
Good. Last word.
To add to that, have a look at DBAW for all world currency hedge exposure, DBEF for the EFA currency hedged, and DBEM for emerging currency hedged, and you're well covered.
Excellent. Thank you, Arne. Thank you, Rob. Great seeing you guys.
You too.
Thank you.
Thank you.